Welcome back to another wild day in the world of finance. I hope you're smiling right now because those good vibes are contagious, and frankly, the markets need it. Crypto's been playing ping pong with our emotions this week, and I'm strapped in for the ride. No, I'm not literally sitting on a rocket ship, but it kind of feels like I am. Yesterday was a spicy day. We saw a strong pump in Bitcoin, Ethereum, and even some of the smaller altcoins, all thanks to better-than-expected retail sales data. But here's the question. Is this the start of a major bull leg, or are we just catching our breath before another pullback? We're going to break it all down today. Bitcoin's new breakout zone, Ethereum's dominance challenge, and a few surprising moves from the traditional finance world that could change the crypto game. Bitcoin right now is sitting at 68, 420 up, about 2% on the day. And it's flirting with that psychological resistance we've been talking about for weeks. Ethereum is trading just above 3.0, which is the level the bulls have been defending like it's the goal line in the last minute of the World Cup final. If Ethereum can close above 350 on the daily chart, we could be in for a momentum push that takes us into uncharted waters for Q4. But here's the kicker. We're seeing unusual correlation breaks. Normally when Bitcoin pushes, altcoins lag or follow in a neat little pattern. This week, not so much. XRP is dragging its feet, while Solana looks like it just had an espresso shot straight to the blockchain. That kind of divergence can tell us a lot about where liquidity is flowing, and right now, it's screaming rotation. Now, I know some people roll their eyes at technical analysis. They'll say, come on, the charts don't matter, it's all about the news. And yeah, sometimes one headline can blast through months of careful planning. But when the dust settles, guess what? Those support and resistance levels suddenly become relevant again, because algos and large traders program around them. Case in point, yesterday, Bitcoin rejected right at the 0.618 Fibonacci retracement from the last swing high. If you think that's coincidence, I've got a bridge to sell you. The big money watches these levels, and so should we. Here's something most people aren't paying enough attention to. Starting this month, a major asset management firm is rolling out crypto exposure to its retirement account clients. That's right. The same accounts your aunt and uncle stash their index fund money into. We're talking about potential fresh inflows from a part of the market that's normally super conservative. Will all that money flood in overnight? Probably not. But give it 6-12 months, and we could be looking at billions in steady, non-leveraged capital entering crypto. And that's the kind of slow burn that can fuel multi-year rallies. On the flip side, we had another big liquidation story this week. One of the top P&L traders on a major derivatives platform got hit for tens of millions when the market wicked down. And that's your friendly reminder. No matter how experienced you are, leverage can bite hard. Think of trading like professional sports. Anyone can pick up a ball, but very few can compete at the Champions League level week after week. The elite traders train, study, and constantly adapt. Most importantly, they survive long enough to catch the next big wave. So where does that leave us? In the short term, I'm watching Bitcoin's breakout attempt and Ethereum's 350 level like a hawk. In the midterm, I'm curious to see how these institutional access changes will shape the market. And, in the long term, I'm still bullish with the caveat that volatility is the price of admission in crypto. Remember, I'll never tell you to buy, sell, or hold. This is not financial advice, just information to help you think smarter about your moves. So if you enjoyed today's ride, smash that like button, subscribe if you haven't yet, and drop a comment. Tell me which altcoin you think will surprise everyone this year. Until next time, my friends, stay safe, stay focused.